Good morning. My name is Gabe, and I spent years in the trades, and now I track industry changes that actually matter to your service business. This is the Trades Brief. There's no bullshit here. There's no fluff. There's no opinions. It's just what changed in the industry recently, why you should care. 10 minutes or less, easy listen on the way to work. Today is the 14th of January, and here is your update. We always do a bottom line up front. For those with a military background, that was a bluff. Maybe it's a TLDR to you, but it's the most important things up front that we cover. So today we're covering 4 signals that all point to the same underlying shift. Housing policy pressure is increasing. Industry groups are responding in real time. Mortgage dynamics may be loosening inventory constraints. And non-residential construction demand is concentrating into fewer, higher value segments. Each of these changes how work shows up for you, who pays for it, and how price-sensitive customers will be. So here's what changed. First, a quick housing policy update. We've talked about this before, but President Trump reiterated plans to restrict large institutional investors from purchasing single-family homes. Thank God. That's not new information for regular listeners, but what matters more is what's happening now after that announcement. So an example of that is industry groups have immediately began positioning around how housing policy could actually work in practice. So the National Association of Realtors is now calling for federal incentives that would encourage institutional owners that already bought those homes to sell the homes back to individual buyers, rather than relying solely on bans or future restrictions. This is not the position of the Trump administration, but it is other industries. This response is important because it shows the housing market has moved into an adjustment phase pretty much officially. When industry groups start proposing alternatives, it usually means they expect change. And they don't know what it is, but they're trying to shape how that change happens. For service business owners like yourselves, this kind of uncertainty affects behavior before any law ever passes because consumers feel it. Transactions slow, large decisions tied to moves or portfolio changes get delayed, homeowners stay put longer while they wait for clarity. And that tends to shift demand away from big, one-time, more driven projects and toward maintenance, repairs, and phased upgrades on existing homes. So second, this longer ownership cycle has another effect on you. When people aren't sure what the market will do, they focus on protecting what they already own. So deferred maintenance gets addressed, efficiency upgrades become more appealing, systems that might have been, quote, good enough get replaced because the homeowner plans to stay a little bit longer. For service businesses, that rewards companies that can explain long-term value, not just speed or price. I think, solar panels, new upgrades, things like that. Third, mortgage dynamics may be starting to ease one of the biggest constraints in housing. So this is new. New data suggests that mortgage lock-in effect could slowly loosen as more homeowners now carry rates above 6% instead of an ultra-low pandemic rates like our rates at like 2.75 or something. This doesn't flood the market overnight, but it does change preparation behavior. People are thinking they want to sell because they can finally buy a new house and not get screwed by their high mortgage rates. So that creates steady work tied to readiness rather than urgency. Inspection repairs, catch-up maintenance, and small projects that they've maybe put off. And now that they're thinking about selling or can because of the mortgage rates, they're going to start hiring you more. Fourth, while residential housing remains mixed, non-residential construction demand is narrowing into specific segments. I know we've all talked about this before, but data centers, power infrastructure, and healthcare projects continue to show strengthen even as broader construction sentiment kind of cools. So for trades and service businesses, this highlights a widening divide. Some markets will get crowded and price competitive. Others will remain undersupplied, regulated, and higher margin. So companies that can qualify for commercial work, handle the compliance and the compliance restraints, which there are many, and operate at scale may find stability even if residential demand becomes more selective and cools a little bit. So here's the signal to watch. Housing policy headlines get attention, but market reactions determine behavior. Housing policy headlines get attention, but market reactions determine behavior. Longer ownership cycles, delayed transactions, and targeted construction demand all favor businesses built around structure, clear pricing, and long-term relationships with their customers. So that's the update for today. If something changes, we'll cover it here every single day. This is the Trades Brief.